Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to CSC Good Night. Today is Thursday, September 4th. I'm your host, Jiang Jida. Remember to like, subscribe, and share our channel during class. If you have investment questions, feel free to comment. If I don't have time to answer today, I'll follow up with everyone in tomorrow's class. All right, let's look at today's investment highlights. Tonight, important economic data will be released, especially the ADP non-farm employment change, announced early around 8:15. So everyone, please be aware, because this will have a significant impact on the job market and shape related expectations. Recently, when it comes to market trends, economic data has been having a huge influence. Whenever there's excessive involvement with the pandemic, it tends to put a lot of pressure on the US stock market, especially since US stocks are now at historic highs. So everyone really needs to be extra cautious. All right, first let's take a look at the economic data and some key investment points. Hi everyone, good evening to you all, and also to Hui Huan Huan. Also, good evening to Min, Faye the Fish, and Alice Fu. Good evening, everyone. All right, okay, so let's take a look at today's first topic, the investment focus. What kind of messages does the Beige Book actually reveal? Also, what kind of dovish or hawkish stances are the Fed members taking? That's something we should pay special attention to. What kind of information did the Beige Book reveal? Why is it particularly important? At 2 a.m. today, the Federal Reserve's Beige Book, which covers the economic conditions of the 12 major districts, was released. It provides relevant information on business investment, consumer spending, as well as prices and the overall state of economic development. So, regarding the content of the Beige Book, we want to remind everyone that its findings can influence the most recent FOMC meeting and serve as a tool for their decision-making. Therefore, if the Beige Book presents a more pessimistic outlook, the FOMC might lean toward a more dovish stance when adjusting monetary policy to provide support. So later on, I'll give everyone an update on what the Beige Book revealed at 2 a.m. this time. Also, why are the committee members in such a hurry to make a statement this week? The key reason is that at 2 a.m. on September 18th, we'll be able to see the results. At the most recent and important interest rate decision by the Federal Reserve, what about this upcoming September 18th rate decision? The general market expectation is that there might be a chance for a 0.25% rate cut. So, about a week before the rate decision, many committee members enter what's called a blackout period, during which they can't make public statements. That's why, before this period, we can expect to see a lot of committee members making statements one after another. Whether they're hawkish or dovish, they'll use this week to express their positions to everyone. So, it's especially important to pay attention to which committee members lean dovish and which lean hawkish, as their stances will play a key role in guiding the direction of monetary policy. Now, moving on to the industry side of things, taking a closer look at the US stock market, another warning signal has popped up. Yet another investment institution has come forward. Recently, UBS was particularly notable for pointing out that, looking at the S&P wink with tongue sticking out 500, whether over 5 years, 10 years, the past 35 years, or even from 1950 to now, history shows that September, or what's often called the September curse, tends to have a relatively higher probability of declines. Yeah. So today, yet another investment institution has weighed in. Who is it this time? Why are they offering a different perspective on the US stock market? This is something everyone should pay close attention to. In addition, when it comes to AI, why do people say AI might take your job? That's because today, two companies released their earnings reports. One is HPE, Hewlett-Packard Enterprise, and the other is Salesforce. These two companies actually had very different earnings results. One rose and one fell in pre-market trading in the US. Why? The key factor is which company received more AI-related orders. Which companies benefit in terms of revenue and profit. If a company's AI development is relatively weak, its stock price or earnings performance might fall short of expectations. And when it comes to whether a stock performs well or not, the use of AI tools can also have a big impact on whether everyday people have jobs or not, so everyone should pay special attention. So today, I'll be breaking down all of this for you one by one. All right, good night. Also, good night to Grace, Leia, and Fanhua. Good evening, good night, sleep well, good night. Teacher, good evening. Well, actually, for you it should be morning in the US, right? Speaking of AI, let me tell you all something. Yesterday, we were talking about AI, right? We were discussing AI tools and all that, weren't we? And I mentioned that video. Nowadays, after every show, we always convert the files and use AI to help us make an international version, right? The English version, you know? Then yesterday, I saw something pretty interesting on the message board. Someone said, "Teacher, what if we don't speak Mandarin, but speak Taiwanese instead?" I think it was a student named Gong Gong or Worker, something like that. He said, "Teacher, if you speak Taiwanese, the AI probably won't be able to translate it, right? So I was thinking, yeah, if I speak Taiwanese, maybe the AI really can't translate it. That way, I could still keep my job as an analyst. Because honestly, nowadays it's so easy. With AI, we can have it do a lot of things for us. For example, if you need to provide some copy or write a report, you can just ask AI to do it. How do you generate related images or sounds? Maybe in the future, the person actually sitting at the table in a group meeting could just be an AI. So let's just give it a try. I want to see if it can really translate this into an English interface. So let's talk about this in line with the suggestion from our colleague. We'll focus on the investment highlights section. What information does the beige book reveal? We'll discuss this part. For example, if I translate it into Taiwanese, let's see tomorrow if it can handle translating from Taiwanese. Also, how do you say beige book in Taiwanese? Pay attention to the news from the public later on. Also, about the committee members, why is that? It's important to express this, because what does one's position really have to do with it? Everyone should listen carefully to the details. Also, about the US stock market. It has a huge impact on the changes in the stock market. And as for artificial intelligence, perhaps it also played a significant role today. Good night, everyone. So tomorrow, let's see if AI can actually help us translate this. Okay? Alright, okay, let's keep going then. Now, about the economic data. Oh, right, let me remind everyone. Next week, Mr. Jiang won't be doing a live stream, so there won't be a live stream next week. Instead, I'll be serving at the branch office. And it just so happens that I haven't been to Kaohsiung in a long time. By the way, I'm actually from Kaohsiung myself. This week, well, actually next Thursday, I have a speaking event in Kaohsiung. The main focus of the talk will be on international stock markets, especially the US stock market, and also on the overall economy. So, next Thursday's event in Kaohsiung will lean more towards US stocks and macroeconomics, not Taiwan stocks. If any of you are interested, you can get in touch with our Kaohsiung branch to sign up for the event. Alright, now let's take a look at the economic data. Will AI go on strike or not? I have no idea if it'll blow up or not. Anyway, around 8:15, let's check out the US ADP employment numbers for August. The previous figure was 104,000, and the forecast is 65,000, a slight decrease. Bloomberg's estimate is 68,000, which is a bit higher. But whether it's 65,000 or 68,000, overall, as long as the upcoming ADP data stays around 100,000, we think the job market as a whole is not likely to be heading into a sharp recession yet. In fact, we can go a step further and say, if number falls within 65,000 to 100,000, then even if it's below expectations, unless it's much lower than expected, people won't be too worried. But if it falls way below expectations, then everyone will start to worry about what's happening in the market. It could lead to an economic recession, but as long as the numbers stay close to expectations or close to the previous value, the market will believe that the Fed still has a chance to cut interest rates in September. And if there's a chance for a rate cut while the economy isn't heading into a recession, that's ideal. So right now, when everyone is looking at these data points, they're all moving in one direction, following one principle. How will the rate cuts happen? Economic data might come in below expectations, but if it's just slightly below or only a little softer, not by too much, then the chances of a rate cut will increase significantly. However, if the data falls way below expectations, with a big gap from what was anticipated, even though it would raise expectations for a rate cut, it would also make the market worry that the economy is heading toward a recession. So when looking at this data now, it's still the same old saying. It's okay if things are a bit softer or slightly below expectations, but don't let it be way off from what was expected. That way, the economy won't be heading toward a recession. And as for the US stock market, it will move in the direction of anticipating rate cuts, which will help support US stocks to fluctuate at these current high levels. And it won't lead to a major correction. At most, it'll just fluctuate at these high levels. But as I just mentioned, the key is that these economic data can show some easing, but they can't point toward a recession. Let me say it again. It's okay for things to ease, but they can't head in the direction of a recession. So, the US stock market still has a chance to fluctuate at high levels, using time to trade for space. That's why you need to pay close attention to the ADP data when it comes out at 8:15. Remember, an hour before market open, you should have a handle on global happenings. By the way, translating that last sentence into Taiwanese is tough, isn't it? Okay, for example, in Taiwanese, we don't usually say things like that, right? Anyway, at 8:30, also pay some attention to the US weekly jobless claims and continuing claims numbers. For the initial jobless claims, the previous figure was 229,000, and the forecast is 230,000. As for continuing claims, the previous figure was 1.954 million, and the forecast is 1.962 million. These will be released simultaneously at 8:30. In addition, at 9:45, there's a more important data point everyone should eye, which is the USS and AMP wink with tongue sticking out global data for August. The purpose of the services PMI, just a reminder, 2 days ago, or rather yesterday, the manufacturing PMI was released, right? Today, it's the services data. Now, in the US market, the services sector is a major component, so the importance of the services data is usually slightly higher than that of the manufacturing data. The services data is represented by this blue line. The previous value for the blue line was 55.4, and the forecast for the final value is also 55.4. So what will the actual published figure be? At 9:45, everyone can check it out together. Now, for both of these data points, whether it's the services or manufacturing PMI, they're both staying above 50, which means they're in an expansion phase, or at least moving toward expansion. Also, at 10 o'clock, there's the ISM non-manufacturing PMI being released. The previous figure was 50.1, and that's also the expected value, but just to add, the consensus estimate is actually a bit higher, forecasting up to 51. So whether it's 50.1 or 51, overall, all the forecasts are staying above 50, which means we're still in what's called an expansion phase. So later at 10 o'clock and 9:45, let's keep an eye on whether the PMI index is still staying above 50. If it's all above 50, whether it's close to the previous value or about the same as the expected value, as long as it's above 50, then there's not much of a problem. Being above 50 at least means the economy is holding up. It's still in an expansion phase. Now, if it drops below 50, say 49 or 48, that's still somewhat understandable. But if the number comes out as 42 or 41, that's a big miss compared to expectations, and then the US stock market will likely react in a more bearish, recessionary direction. Even though, yes, that's favorable for rate cuts, the economic data can't be too far off. If the data is too far off, everyone will start worrying that we might be heading toward a recession. So, these are the data points at 9:45 and 10 o'clock that I'm sharing with you. Later, at 8:15, we'll be tracking the ADP-related information for you as soon as it comes out. Otherwise, some people might end up out of a job, right? I'll talk more about this with everyone later anyway. The two companies releasing their earnings reports today are actually related to AI. Also, in addition, the US Fed's Beige Book also mentions some interesting things about AI. The Fed's Beige Book usually covers things like economic growth, inflation, the job market, consumer spending, and business investment, these 4 or 5 main topics, right? But this time, it specifically mentioned AI as well. So what exactly did the Beige Book say about AI? Will we end up without jobs? Whether or not we have jobs is really important. So what should we do about it? If you want to have a job, of course you need to improve your survival skills. The more skills you have, the more opportunities you'll have to survive. That's basically how it is. Now, let's take a look at the positions of officials and investment institutions. First, let's talk about the so-called quiet period that usually happens about a week before Director Lin's policy decision meetings. During this quiet period, many officials are prohibited from making any statements about monetary policy. This is to prevent anyone from influencing market expectations. Now, what about Waller? Waller was actually appointed as a governor during Trump's first term. Back then, there were 2 governors at the Federal Reserve who were appointed by Trump. One was Waller and the other was Bowman. Coincidentally, both of these governors appeared during the interest rate decision at the end of July, just a couple of months ago. They both took a stance against keeping interest rates unchanged. These 2 governors supported a rate cut of 25 basis points at the end of July, but things didn't go as they wished, since the majority still supported holding rates steady. Now, in the September 18th interest rate decision, we can see that many committee members, including those who lean more toward Trump's views, even the more dovish committee members have stepped forward one by one. Now, why is Waller's rhetoric even more dovish? It's because he's also a very strong contender for the next Federal Reserve chair. Out of the 11 candidates, he ranks near the top. Just remember Waller, Waha, and Ha, these 3 are the top 3 frontrunners among the candidates for Fed chair. Who are the 3? The first is Waller, the one you can trust. The second refers to the former member, Liswash. The third is the current economic advisor, Hassett. So Waller, Wash, and Ha, just remember these 3. No matter which of them is chosen, the overall direction of the Fed's operations will lean more dovish, because they tend to support Trump's stance. So what did Waller and Liswash mention? They said that at the next meeting, which is in September, there should be a rate cut. And starting from September, there should be more and more rate cuts in the future. He believes that the current monetary policy is already restricting the economy, and that they can't wait until the entire job market starts to decline before cutting rates. By then, he thinks it would be too late. He expects that in the next 6 months, or half a year from now, inflation will get closer to the 2% target. And he doesn't think the economy will go into a recession. At most, the economy will slow down. Okay, so you really need to remember this statement. He doesn't think there will be a recession, but economic growth will slow down. What does it mean for economic growth to slow down? It means that in the next 3 to 6 or even 8 months, After passing through this tariff barrier, tariffs will gradually start to be imposed. As business costs go up, consumer spending drops, and business investment decreases, what will happen to GDP? It will keep going down. We talked about the GDP formula. C plus I plus G plus X minus N. C stands for consumer spending, G is government spending, I is business investment. And then X minus N, one is exports, and the other is, well, you subtract imports. Oh, so it's exports minus imports, that's the number. So these four components, when added together, make up the elements of GDP. Whether GDP declines or grows, these four factors are extremely important. Now, of course, it was said that the economy won't decline, but will tend to stabilize. I actually agree with that because looking ahead, by the fourth quarter, the economic data for Q4, or things like tariffs, could see an increase in inflation. In addition, consumer spending and corporate investment might be affected by the costs associated with tariffs. So everyone still needs to be a little cautious. Looking at September, there is still pressure for a pullback after the recent gains. So everyone should pay close attention to position management. This aligns more with a dovish perspective. In addition, Bostic and Kashkari, who don't have voting rights, mentioned that inflation is currently the main risk and that the labor market is weakening. And they also said that one rate cut this year would be appropriate, but they didn't specify whether it would happen in September or December. There was no mention of timing. Overall, though, they are more supportive of a rate cut. Additionally, another member, Kashkari, said that there is still room to lower interest rates, but he didn't reveal when easing might happen. So, in short, everyone will notice one thing. The members who lean more toward Trump are very proactive. They're telling everyone there will be a rate cut in September, another in December, and that more cuts will continue in the future, right? But if you look at the more neutral members, those who take a more centrist stance, well, not the voting members, but those without voting rights, the members who don't lean toward Trump, their statements are more objective and neutral. They say, well, it's possible there will be a rate cut this year, but maybe just once or twice. As for which month the cut will happen, that will depend on the economic data at the time. So their statements tend to be more objective and neutral. Now, there's another one who is also more dovish and leans toward Trump. This person is called Milan. Milan is a candidate for a board member. So what did he say? He said some things that are basically blatant lies. Why do I say he's lying with his eyes wide open? Of course, he was chosen by Trump, and Trump wants to place him in the Fed to be more dovish and push for rate cuts. Basically, that's the idea. No more pretending, it's just about how to get him in as a puppet. So what about this board member Milan? Right now, he hasn't been elected yet. He still needs to go through votes from the Senate, the Banking Committee, and so on, before his appointment is confirmed. Now, if he does get the position, he says that if he takes office, he will uphold the independence of the FOMC, which is the Federal Open Market Committee. The independence of the Open Market Operations Committee. Now, before this, what's interesting is, why do people say he's blatantly lying? It's because he claims that after he's elected, he'll maintain the independence of the Federal Reserve. But you and I both know that's impossible, right? Because he's the person Trump picked and wants to use. And Trump wants to cut interest rates, and he wants to do it aggressively. So if Milan is chosen, how could he possibly maintain independence? It's impossible. He'll definitely be influenced by someone. He'll definitely listen to someone, listen to Besant, listen to Trump's opinions. That's what it means. So before this, his stance was even clearer. He said he supports Trump's view on interest rates, which is to keep cutting rates. In addition, he even advocates that the president should strengthen control over the Federal Reserve. So do you really think they can maintain independence? He even supports the president controlling the Fed's monetary policy. So, to put it simply, what he said was really just for the senators on the committee to hear. As for Milan's term, it's expected to end at the end of January 2026. So let's take a quick look, regardless of whether these committee members have voting rights or not. Honestly, most of them are pretty neutral, with some leaning dovish, mainly neutral to dovish. So it's reasonable to predict that maybe in this September's interest rate decision, there's a pretty high chance, about 80 to 90%, that there will be a rate cut of 0.25%. So in September, there's a good chance we'll see a quarter-point rate cut. If there isn't a rate cut in September, then the chances of a cut in October or December get even higher, because basically, before the end of this year, we can expect 1 or 2 rate cuts. That's definitely something to look forward to. So everyone, just keep an eye on the related news. All right, good evening to Ami Ling, also good evening to Anna Wu Buji and Xiaomao Lu, and also to Thomas T. Thomas, good evening, and to this character as well. Good evening, Hector. For us, next week I'll be giving a talk in Kaohsiung, so everyone just take note. If you need to register with the Kaohsiung branch, go ahead and do so. That's next Thursday. Okay? Alright, let's take a look at Milan. What about Milan? It's about the centennial celebration, right? Yes, that's correct, that's exactly it. Oh, so everyone, it's like that previous Mar-a-Lago agreement, where they said the US dollar would continue to depreciate because a weaker dollar is good for exports, right? It's beneficial for exports. And then, they talked about balancing trade, saying that imposing significant tariffs is necessary to eliminate the trade deficit and achieve balance. That's the kind of thing he proposed. Also, he wanted other countries to buy US bonds, specifically zero-coupon bonds. Basically, you can buy US bonds, invest in our US bonds. But the US won't pay you any interest. You can only buy zero-coupon bonds, and if you buy a 100-year bond, you can't sell it. That's Melani's idea. That's Melani. Why does Trump like him so much? Because, in fact, Melani back in, was it 2020 or 2017, around that time, back in the previous time during Trump's first term, he actually served as an advisor in the Treasury Department. And this time, his current position is basically the chairman of the Council of Economic Advisors. So his background is actually quite impressive, as we've mentioned before. He has a PhD in economics from Harvard University. He's really smart, a genius, in fact. He has a PhD in economics from Harvard, and he's bald, wears glasses, and looks quite young in his 40s, just a little over 40, maybe 44 or 45 years old. He's a very young person, so he's definitely considered a talent. At just 62 years old, he's already serving as a board member of the Federal Reserve, which is considered quite young. Now, looking back at this, for example, the Beige Book and other reports, I actually think they provide a relatively objective summary of economic data. This will give the Federal Reserve an important reference point when making decisions about interest rates in September. So, regardless of whether these committee members lean dovish or hawkish, we should try to keep our focus on the fundamentals, on macroeconomics, and on the real changes in the data. If the data is relatively weak, then the Fed will indeed move toward rate cuts. If the data remains very strong and shows significant growth, then not so much. If the data is strong, then it's perfectly reasonable for the Fed not to cut rates, right? That's why the economic situation and, for example, the Beige Book can serve as an important reference, because it tells everyone whether the likelihood of a rate cut in September is high or low, providing significant guidance. Yeah. So what about this time's Beige Book? The Beige Book says, what does it say? It says that economic activity is currently flat, which shows that the current economic momentum is weak. Economic momentum is weak. Yeah, weak. When it's weak like this, it supports the case for a rate cut. Most regions are seeing moderate price increases. If inflation is too high, it's not necessarily suitable for a rate cut. Yeah, if inflation is too high, it's not suitable, no rate cut. It says the reason for the moderate increase is because of businesses. In response to tariffs, it says that businesses have reacted to these tariffs, so they had to raise prices, which in turn has caused consumer spending to remain flat or even decline. The rate of wage increases is also lagging behind price increases. Overall, there has been no change in the job market. But he says, butter. These businesses, they are laying off employees in two ways through two different methods. Why do they need to cut costs? Why do they need to cut costs? Because they realize that the overall costs are too high, producer prices are too high, tariff costs are too high, so these major companies have to implement some kind of human resources management. If there are people they don't need, they just lay them off. So how do they do it? Simple. You can't just lay off a bunch of people all at once. If you do that, your company might get called in by the Department of Labor, or even Trump might get upset and say, why did you lay off 6,000 people or 2,000 people all at once? If he calls you out, it could cause problems for your policies and the way your company operates. Because Trump doesn't want tariff issues to cause what? To cause people to struggle to make a living, to cause layoffs, to cause people to lose their jobs. But in reality, this is going to happen. It really will happen, no matter how much Trump dislikes it. The fact is, once tariffs go up, companies' costs go up, and so do labor costs. When costs go up, companies have to take measures like layoffs or cutting costs in order to keep the business running normally. So what are the two methods these companies use? The first one, they require employees to return to the office. Back during COVID-19, you could work remotely, you could work from home, right? But now they're asking everyone to come back to the office. For some people, the commute might be long, or it might not be convenient, so what do? They end up choosing to resign. There's also this method, which just lets some people be naturally eliminated. The second way is using AI tools and automation to reduce the number of employees. So, through AI, maybe some translators or people working in customer service, like telecom or voice support, are replaced by AI. They don't need to hire so many people anymore. Gradually, more and more companies are doing this. So, by using AI and implementing return-to-office policies, companies are reducing their workforce. As for businesses, they're currently worried about tariffs, high interest rates, and immigration policies. 20% of companies believe that demand for their goods and services will decrease over the next 6 months. What does this mean? If you look at this Beige Book, the content this time is actually quite extensive. Honestly, this Beige Book covers a lot, goes into great detail, and there are many variables. After reading it, everyone can see that, first, the economy is starting to slow down, and the labor market is beginning to weaken. Although there isn't a recession, it is getting weaker, and many companies are starting to cut costs and lay off employees, with business costs rising. In addition, as we just mentioned, companies are worried about tariffs, high interest rates, and immigration policies. And most importantly, 20% of companies believe that the demand for goods and services will decrease in the future. What kind of situation will that lead to? Once it drops, let's look at the next thing. When tariffs go up, prices rise and consumer spending increases. For example, a bowl of plain noodles used to cost $25, but now, because of tariff issues, the cost of materials and raw ingredients has gone up, so everything is more expensive. Even disposable chopsticks are pricier. Although now everyone talks about being environmentally friendly, so you bring your own chopsticks and spoon, which is fine. But for these noodle stalls, if you buy paper bowls or plastic bowls, whatever kind of bowl, the cost goes up. All the costs go up. When products like oil, salt, soy sauce, vinegar, and tea, basically all daily necessities, get more expensive, that bowl of plain noodles that used to be $25 will at least go up to $40. When it hits $40, it might start affecting how much people are willing to spend. So, when consumer spending goes down, when it decreases, receivables for businesses will also decrease. So when business revenue drops even further, what happens to business investment? It goes down as well. Everything is connected, one thing leads to another, and this will end up putting a constraint on overall GDP growth. So with this kind of impact, GDP might decline. That's why everyone needs to pay special attention. The content of this merger document is actually pretty neutral, maybe even a bit cautious and pessimistic, so everyone should keep an eye on this. Of course, the Federal Reserve might cut interest rates in September, because it seems like the economy and the job market are both looking a bit weak, leaning toward the softer side. If they don't cut rates soon, GDP might just keep dropping, and it'll be much harder to save the situation later on. So that's what the merger document is referring to. Let me add a bit more for everyone. Okay, now let's take a look at the economic data. First, let me greet everyone. Fan Hua, good evening, and also SY Lu, good night. So, does the beige book say the economy isn't doing well? Somewhat weak. Like we just mentioned, it's leaning towards being soft, whether it's the job market or what's it called, like we just said, both employment and the economy are on the weaker side. Okay, about Teacher Ji-min's briefing. Don't forget, it's not today, it's next week. Teacher, next week, next Thursday, there's a briefing with a talk. Alright, let's take a look at the economic data. Just now, at 8:45, the US ADP small non-farm payroll data was released. The number came out at 54,000, which is lower than expected and lower than the previous value. This means the entire job market is indeed heading in a slower direction, and the slowdown is becoming more and more obvious. The slowdown is getting more and more pronounced. This also matches what we just tracked in the beige book, where it mentioned that the overall job market. It seems that a lot of companies are telling their employees, either come to work, or you'll be replaced by AI tools. So we need to pay a bit more attention because over the next 6 months, demand for goods and services might drop as a result. So, in the ADP small non-farm payroll report today, the number is at 54,000. Although it's not a huge drop, not a continuous decline, and we're not seeing a recession yet, at least not at the moment, the slowdown is very, very obvious. Of course, this increases the likelihood of an interest rate cut in September. So, I just wanted to share this 8:15 data point with everyone. Also, around 8:30, I'll walk everyone through the employment numbers as well. In about 5 minutes, the relevant information will be released. Before that, let's add something else. In the US, aside from last week when UBS gave a somewhat cautionary or negative outlook, today there's another institution, Bank of America. Bank of America is also a very important reference for investors. They said that this year, the performance of various asset classes has been more divided, with gold leading the way. Gold has hit new highs. I remember it's almost $33,600. It's extremely high. As I vaguely recall, gold just keeps going up and up. Why does gold keep rising? It's all about risk, tariff issues, then something with France, then the UK, then Russia and Ukraine, and now political turmoil in the US, increased fiscal burdens, and a national debt of $36 or $37 trillion. It's just so much. And then every now and then, Trump comes out and makes some statements, and now it looks like things might be heading toward rate cuts. The more we move toward rate cuts, the more the dollar tends to fall. Rate cuts make it easier for the dollar to go down, and as the dollar drops, that in turn supports gold to keep climbing higher. So, the US dollar and gold have an inverse relationship. When the dollar gets stronger, gold tends to fall. When the dollar weakens, gold gets stronger. With all these risk-averse and external factors coming together, we can see gold continuously hitting new highs. I vaguely remember maybe 4 or 5 years ago, I remember gold was only about $1,400 or $1,500 per ounce, which was already considered pretty high at the time. I still remember back then, if you took your gold rings or gold medals from home to pawn or sell them, if you went to a jewelry store to sell, the price was actually pretty good. But who would have thought that after 4 or 5 years, wow, gold has more than doubled from $1,400. It's now reached as high as $3,600 per ounce. $3,600. That's sky high. So what does Bank of America say? They say gold is leading the rally in mainland Chinese stocks, and the Chinese stock market has regained some buying momentum. What they think is more important is that the valuation of the US stock market has reached bubble territory. Why do they say the US stock market is at bubble? They provide a few points, and I think everyone should note them. The first thing they mention is, right now, the price-to-earnings ratio is 27.4 times, which is extremely high. 27.4 is very high. Let me add another piece of information for everyone. Over the past several decades, the average P/E ratio per share in the US stock market has been about 19 to 22 times. So 19 to 22, maybe sometimes 18, 17, 19, up to 22, roughly in that range. Now, it's at 27 times, which really is an exceptionally high valuation. Really high. Generally speaking, the P/E ratio usually stays around 20, give or take a little. According to the data, historically, only about 2% of the time, just 2%, has it exceeded this level, meaning gone above 27.4 times. Only 2% of the time. The remaining 98% of the time, it hasn't. First, the P/E ratio is overvalued. Second, it mentions something important in the US, the Magnificent Seven. We use the mnemonic Wu Yiping de Lian Tail Wan. Wu Yiping de Lian Tail Wan. Every time we hold a seminar, we teach everyone this mnemonic. Wu Yiping de Lian Tail Wan. These 7 companies, plus what? Add Broadcom, ABGO, and then Oracle. And then there's PLT, which stands for plenty of. With these 3 companies added, their total market value actually reaches 39%, accounting for nearly 40% of the total market cap. He says, why is this 40% so significant? Because back in 2000, during the dot-com bubble, there were also just a few dominant companies. The proportion is as high as 40%, so what he means is that the current stock market has already become highly concentrated in certain specific industries or individual stocks. If any of these stocks or industries were to suddenly fall from their pedestal, even just one of them, since they now make up 39% or 40% of the total, right? If they take a hit and drop, boom, just like that. You can probably imagine that if these companies, which make up about 40% of the total, were to drop, the US stock market could end up in a daze, tumbling all over the place. So his suggestion is that, in the second half of the year, you should increase your stock holdings and use gold as a hedge. So, it's still the same old saying, you know. Whether it's UBS or Bank of America, they are indeed making some relatively pessimistic or negative comparisons. So everyone should pause and take a closer look, because after all, the so-called September curse is still something to be wary of. You should still be on guard, because if something goes wrong, it could all come crashing down in an instant, you know. It's a big problem, because right now we're at a historical high. We're at a historical high, so you need to pay a bit more attention. As for the yield, it's dropped down to around 4.2, with the terminal rate at 3.74. Why? Because a lot of officials have come out and made more dovish comments, talking about rate cuts and being proactive about cutting rates. So the yield on the 10-year government bond, well, yesterday and the day before, even though it was affected by some negative news about fiscal spending from the UK and France, and then the yields on UK, German, and French bonds, we've talked about this before, they shot up, went really high, and then maybe the yield on US bonds was also pushed up to some extent, but I think those are just short-term factors. Basically, people are just looking for reasons to explain the drop. So after a day or two of this playing out, you notice that as soon as an official comes out with a dovish statement, the 10-year government bond yield immediately drops, falling below 4.2% in a flash. Even the expected number of rate cuts has come down to about 2.3 times. So overall, when I think about the statements from officials around September 18th, along with the Fed's economic outlook and the Beige Book, which are leaning more conservative or expressing concerns about a possible recession, if you look at it from this perspective, the chances of a rate cut in September are quite high, very high, actually. As for the US dollar index, it edged up by 0.007%, still holding around the 50-day moving average. Now let's talk about this. It's 8:30. Let's first look at data just released at 8:30. By the way, good evening to everyone. Trump supports a weak dollar and low interest rates, that's right. Okay, let's look at initial jobless claims. What's the latest number for new claims? It's gone up a little bit, now reaching 237,000 people, which is higher than expected and also higher than the previous figure. The previous number was 229,000, and the forecast was 230,000. As for continuing jobless claims, the number is 1.94 million, which is actually lower than expected and also lower than the previous figure. So, the latest initial and continuing jobless claims are kind of a mixed bag. The initial claims number is up. It's higher than expected, but the number of continuing claims is lower than expected. So overall, looking at this data, the job market is a mixed bag. Here, to sum up, the job market is a bit of a mixed picture. But one thing is certain, the current slowdown is definite. The job market is definitely slowing down right now. This is also confirmed. It's just that the initial and continuing claims are basically one good and one bad, so I wanted to add that for everyone. Okay, so this is the number of jobless claims that was just released at 8:30. Overall, of course, this more or less increases the probability of a rate cut. More or less, it still raises the chances of a rate cut. Everyone should be aware of this. Finally, let's take a look at the geopolitical risks. Alright, regarding the geopolitical risk section. Oh, I actually forgot to change the title here, it's just been way too busy today. So, let's talk about India's trade minister. When it comes to the trade war, whether it's India, Canada, or the EU, if we look at it simply, these commissioners, officials, and prime ministers are all still, one after another, continuing to have discussions with Trump. India, in particular, hopes to reach an agreement with the US before November. Whether there's a chance or not, we don't know, because the talks have been going on for a long time and are still ongoing. As for Canada, they've also said they've had conversations with Trump, but they've also sent special envoys to communicate further. The EU, even though it has a relatively low reciprocal tariff of 15%. However, they're still hoping to secure more and more tariff exemptions. Anyway, the negotiations are ongoing and will continue. As for Trump, he mentioned that there might be a second or third round of oil sanctions against Russia, but honestly, that's just empty talk, so it doesn't really mean anything. Why do I say that Trump is just for show? Because everyone knows that, in reality, Trump and Russia's Putin have a lot of agreements and communications going on under the table. Often, Ukraine's Zelensky and his people are left out of the loop. There's nothing that can be done about it, because when major powers are playing their games, sometimes the interests of smaller countries have to be sacrificed. Then Trump said that he hopes Europe can stop. Isn't it interesting to talk about buying Russian crude oil? Europe has always wanted to sanction Russia, but in the end, Europe is still buying Russian crude oil, and they're still buying a lot of Russian natural gas too. And you don't see them stopping either. So what did he say? He said he hopes Europe can join the countries sanctioning those who buy Russian crude oil. But obviously, that's impossible. Why? Because Europe is still buying Russian crude oil right now. So Trump, you want European countries to join in sanctioning those who buy Russian crude oil. Doesn't that contradict itself? Because Europe is buying Russian crude oil, and if you want to sanction countries that buy Russian crude oil, doesn't that mean you want to sanction Europe itself? How could Europe possibly agree to that? There's no way they would. That's why I say this kind of sanction is inherently contradictory. You keep saying you want to impose sanctions, sanction crude oil, sanction natural gas. But in reality, you're stepping on Europe's toes. You're infringing on Europe's interests. So it's really hard to make it happen. Trump talks about sanctions, but imposing them might be a solo act. Whether it passes is another story. This news hasn't impacted crude oil prices. In fact, prices dropped nearly 9% in a single day. Overall, crude oil prices are still bearish, consolidating. Alright, as for the economic data, like we just mentioned, just pay a bit of attention to the service sector PMI around 9:45 and 10 o'clock tonight. That should be enough when it comes to the data side of things. Now, moving on to industry news, let me give everyone a quick reminder about this. Bloomberg mentioned that Apple is currently developing an AI-powered web search tool, kind of looking to step into Google's territory. They say it's expected to launch next year, which is just 3 or 4 months away. It's also mentioned that Apple might end up both competing and collaborating with OpenAI on this. Internally, this AI web search tool is called Word Knowledge Answer, which kind of means it's an answer to the world's knowledge, a big comprehensive search, that sort of vibe. So, they're talking about how Word Knowledge Answer might be integrated into Siri, the browser, and possibly even involve some collaboration with Google. As for this information, I think it's just something to take note of and move on. Rushing over there, first of all, even if they really do develop this AI web tool, it's going to take a long time. It might not happen until next year, and whether that's January, February, March, May, or even the end of next year, nobody knows. So, let's talk about next year's things when next year comes. It's still a long way off. That's the first point. No need to worry about it. Second, even if it does get developed, who is this web tool really going to compete with? Can it really take down OpenAI? Or is it actually going to collaborate with Google? Or will it be competing against Google? Right now, all of this is still unknown. So I think at this stage, this news doesn't really help Apple much. We'll have to wait until next year, when it's actually developed, to see where we should focus our attention. For now, aside from yesterday's news, the focus is still on Google, because of the antitrust ruling. The judge ruled that Google doesn't have to break up its browser or its Android system, so this is actually a big win for Google. In addition, Google is also legally authorized to collaborate with Apple devices, and that annual payment of $20 billion will continue to go to Apple. Why? Because of Apple's phones. The default search engine entry on these phones is Google's search engine, so it's really a mutually beneficial relationship. So right now, as long as Google keeps going up, this positive news will of course also drive up both Apple and Google stock prices, as we saw with their big gains yesterday. So now, with both of them surging like this, both of the AA stocks are surging. So the two A's refer to Alphabet. Alphabet is Google, right? Our company Alphabet. The other, who is that? That's Apple. So these two, Apple and Alphabet, their stock prices were the main reason the tech sector rallied higher yesterday. Now, as for the second short-term factor, we don't really need to look at things like AI web search. This doesn't help Apple much. What everyone should pay attention to is that next week, on September 10th, Apple will be holding its iPhone 17 launch event. I think this is more important and more practical. As for how this new AI-enabled device will advance Apple's AI strategy, that's something we all need to keep a close eye on. If there are some new highlights, if the progress is pretty good, and new features are introduced, like if the phone is more innovative, maybe ultra-thin, or even foldable, or has some different functions, then that could be more helpful for Apple's revenue or shipments. Oh, actually, the layout of AI and smartphones is going to be more important. As for web development, you don't really need to pay attention to that. I don't think it's that significant. Okay, just to update everyone, yesterday Apple's stock price went up by 3.81%. It's still holding above the 20-day moving average and is gradually climbing higher. As long as it doesn't fall below the 20-day moving average, we can still expect a steady rise. Right now, among the so-called Magnificent Seven, we've talked about Apple, because it holds a relatively large proportion. Its weighting is also quite high, so if Apple continues to climb higher, in a way, it serves as a very important support. These heavyweight stocks are a key tool for keeping the US stock market at high levels. So if Apple manages to do well next week, if it continues to make progress in AI development and has highlights in its new products, then its ongoing rise will be a big help to indices like the Dow Jones, Nasdaq, and so on. So that's a quick review and follow-up on Apple for everyone. Alright, now let's take a look at the other two companies. Alright, let's take a look at Hewlett-Packard, HPE, and HP. So what did they say? Were they affected by AI? Well, the demand driven by AI has led to pretty good performance in their financial reports. We're already talking about Q3. They've released their Q3 financials, which were better than expected. But what about their revenue outlook for Q4? It fell short of expectations in terms of revenue, but its EPS performed well and beat expectations. They even raised their full-year revenue and EPS forecasts. So overall, driven by AI, I think this is still pretty positive for Hewlett-Packard. As for the stock price, it went up slightly by 0.6% yesterday, which is not bad. You can see that as long as there's some connection to AI, there's a boost. As long as your company can get involved with AI, whether it's AI servers, AI cooling, AI-related PCBs, or any kind of AI, even things like AI robots, AI big data, AI vision, and so on, if you have anything to do with AI, then basically your stock price won't do too badly. And the key point is, if you really are making money from AI, whether it's through AI platforms or other AI-related things, and your revenue and orders are actually rising because of it, then that's what really matters. So, the market tends to view the stock prices of these companies more positively and has higher valuation expectations for them. As for Weight Technology, looking at the current situation from April until now, it has continued to steadily climb above both the 20-day and 50-day moving averages. The overall bullish trend hasn't changed at all. And today, before the US stock market opens, there's still momentum pushing higher, which is also something to keep an eye on. But another company, on the other hand, is relatively weaker. But the company called Salesforce, also known as Saifushi, specializes in customer relationship management, or CRM systems. In their second quarter financial report, although both revenue and profit met expectations and performed very well, really impressive. Plus their remaining performance obligations and other metrics grew by 11%, so overall the performance was good. However, their revenue outlook for the third quarter fell short of expectations, coming in at $10.27 billion. As for the full-year revenue forecast, it was only maintained. It just stayed the same without any increase or upward adjustment. Like we mentioned earlier with HP, Huayu Technology, they even raised their revenue and EPS forecasts, which was pretty good. But as you can see, Salesforce just kept their full-year guidance unchanged. And then, third quarter revenue just missed expectations. Why? Why couldn't they raise it? Because they said that at this stage, the company is facing pressure from the ongoing AI transformation and the trends in the AI market. So, the company is also promoting and rolling out software related to AI assistance. So what does this AI assistance software do? It's designed to help customers automatically handle customer service issues. Yes, to automatically deal with customer service problems. And through these AI tools, Salesforce, the company itself, has already drastically reduced its workforce from 9,000 employees down to 5,000. In other words, 4,000 people have been laid off. That's half. You can imagine, for a company, if nearly half of its employees are laid off. How many people are left out? That's a problem for so many families. So why were they laid off? Because AI tools replaced their jobs. Why did AI replace them? Because AI can automatically handle customer service issues. Just think about it for a moment. When we use like those banks or some ATM or financial services like China Trust, Fubon, or whatever, any online banking app, if you ask it some questions like issues online or customer service questions, actually you can ask it anything and it can answer a lot of things for you. But those answers aren't from real people, they're all robots. The ones answering you are computer customer service agents. AI customer service answers you. They use big data and then, based on your questions, they aggregate relevant information from big data and find related answers to respond to you. So they don't actually need real people to serve you. As long as you provide, say, a question about your bill, a question about transferring money, or a question about fixed deposits, the AI can handle it. You just click on the options, and it gives you the answer for you to read yourself. Can even answer you using voice. So, actually, this kind of thing will invisibly replace a lot of customer service jobs. So, if your job is related to customer service, it might get a bit tougher for you in the future. For example, jobs like phone customer service, telecom customer service, or bank customer service, and so on. Even jobs like translation, marketing, or being a writer could be impacted to some extent. For instance, this company I mentioned already laid off 4,000 out of 9,000 employees, which greatly reduced their operating costs. So, using AI to cut down on manpower needs has already become a trend. So, what about Salesforce? Why did its revenue perform poorly in the third quarter? And why is the full-year outlook just flat, not raised? It's because the company is still in a transition period. Previously, they relied on too many people, too many employees to serve their clients. Now, if they cut down from 9,000 to 5,000 employees, that will lower their costs to some extent. As they use more and more AI tools, what might happen is this shift will improve their profitability and gross margin, even if revenue stays the same. However, in the short term, the results aren't visible yet. It will take time to see the impact, so we'll have to observe over the long run. Since Salesforce hasn't been able to fully leverage AI in the short term, its stock price has performed very differently from HP's Huayu Technology. Huayu Technology stock is trending upward between the 20 and 50 moving averages. But if you look at this company, Xian, what's going on? Its 20-day and 50-day moving averages are still showing a bearish pattern. In the short term, after a sharp drop, there's been a rebound from around 220 up to 256. This move just happens to be running into resistance at the 50-day moving average. And above that, there's also resistance at the 200-day moving average. So, for now, it's best to treat this as just a short-term rebound after a steep decline. Also, because revenue expectations weren't met before the market opened, the stock dropped quite a bit. Alright, I'll provide you with the data and financial report. So, will AI really replace people? Honestly, I don't know, okay? A lot of jobs are outsourced, just outsourced. Some people say it's like outsourcing to Indians. There are tons of customer service jobs outsourced to India. I vaguely remember that. I used to use that Asus. What was it called? That Wi-Fi router from Asus. You know how you have to do some setup, right? There are some setup functions, but maybe you don't know how to set it up, because the features are written in a really complicated way. So you want to just call customer service directly. I remember when I called customer service, honestly, the person who answered didn't have a Taiwanese accent. Not a Taiwanese accent at all. The accent was Mandarin, but maybe from Singapore, Malaysia, or Indonesia. I don't know which country exactly. But when you hear their accent, you can tell it's not a Taiwanese accent, but it's also not a mainland Chinese accent. Definitely not from the mainland. It's a Southeast Asian accent, but we don't really know which country exactly. So, like what the nuclear force team just mentioned, actually, a lot of our customer service jobs are now outsourced to other countries. Of course, there are still some. Taiwanese customer service does have its own advantages, but the cost is just higher, you know. Now, as for companies rising in the US stock market pre-market trading, the first one is HPE, which went up 3.1% before the market opened, mainly because of its revenue and also because it raised its full-year revenue forecast. Amazon also rose 1.5% in pre-market trading, reaching $229. Tesla was up 1.45% before the market opened, at $339. As for Meta, it went up about 1.3% in pre-market trading, roughly 1.1%. In addition, Broadcom also rose by 0.85%. As for the companies that dropped, like I just mentioned, Salesforce, maybe a lot of jobs there are being replaced by AI. Salesforce fell nearly 7% in pre-market trading, so keep an eye on that. Also, Freeport-McMoRan Copper and AMP. Gold was down 1.45% before the market opened. These are the pre-market updates for US stocks that I'm sharing with everyone. As for the Dow Jones Index, among the 4 major indices, it's relatively strong, fluctuating between the 50-day and 20-day moving averages, but still holding up well. At least it hasn't fallen below the 20-day moving average, so it's gradually moving higher along the monthly average line. Of course, it's also a key indicator and concept index for tracking Trump's performance. Now, for the Philadelphia Semiconductor Index, you need to be a bit cautious in the short term. Even though it only dipped 0.23% yesterday, both the 50-day and 20-day moving averages have already been breached. Both moving averages have been broken at the same time. If, in the future, the 20-day and 50-day moving averages gradually shift from rising to flattening out, or even start to curve downward, then the pressure at the top will become relatively greater. So, everyone should be especially cautious with related stocks, including companies like Nvidia, Intel, and TSMC. These companies have already nearly doubled in price. It's wise to consider taking some profits when prices are high. Put those profits in your pocket. As for your stock holdings, try not to let your position exceed 50%. For now, a safer approach is to keep investing in index funds. Yesterday, thanks to the boost from the two stocks, Alphabet and Apple, the market was driven up. They performed pretty well, climbing back above the 20-day moving average. Overall, it's still fluctuating between the 20-day and 50-day moving averages. Yesterday, it went up by 2.22%. As for the future, of course, we still need these stocks to keep leading the market and serve as a focal point for investor confidence. So I think that while the market is fluctuating in the short term during September, regardless of tomorrow's non-farm payroll and unemployment rate, next week's CPI and PPI, or even the Fed's interest rate decision on September 18th the week after next, no matter what the economic data shows, no matter how big or small, everything will have an impact. Let's just say that the volatility in the US stock market will also be more intense because there are still a lot of uncertainties. So please be very careful with your position management. That's all for the latest updates related to the group before the US stock market opens. If you found this helpful, remember to like, subscribe, and share during the break. Finally, I wish you all successful trading, and I'll see you tomorrow.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.